Hey guys, welcome to Investing for Generational Wealth. I'm Keshav Kulor and I'm joined by my co-host, John Lai from Clive Capital, where we help high earners just like you invest outside of the stock market to passively achieve long-term wealth generation through superior risk-adjusted returns, long-term passive income, and tax benefits. Together with investors, we've helped them invest into over 1,000 apartments and 500 single family homes so far. Before we begin, a quick disclaimer. We are not financial advisors. All investments are subject to risks, including the possible loss of the money you invest. So perform your due diligence and ask your CPA, your attorney, before making any investments. John and I, we just like to dress up nice and talk here on Wednesdays. That's it. I'm your host, Keshav Kulor, and again, my co-host, John Lai. Welcome to today's episode, Construction Brat to Multifamily Millionaire. Today's guest is Sharon Riddle. Sharon, could you share a little bit about your background and how you got to where you are today?
Certainly.
Let me also say thank you for joining us today.
Well, Keshav, you and John are very welcome. Well, I started my real estate journey. I'll really talk about that portion because everybody's interested in that back in 2005. And what I did is I have my business partner who is also my spouse, always an interesting situation, Dan Riddle. And we started our first portfolio of single family homes. That was S&D Properties. And we had single family homes in the DFW area, the Dallas-Fort Worth area. And then moving forward through that, we discovered that despite working with private lenders, that we could not expand our portfolio to the scale that we desired. And we became multifamily investors. We were connected to a multifamily mentor by a single family mentor. And so back in 2015, we started our journey to multifamily investing. And we worked with Brat, who was our multifamily mentor in that space. And we grew our portfolio of multifamily investments to 18 properties totaling 3,507 doors during that time, about half of which have gone full cycle. So we've experienced the gain side of that, and that's what everybody likes to see in the exit strategy. So that's what we've done, and we still have some active passive investments at this time. We are on the hunt with our general partner team for our desired multifamily investment, and we have our criteria. So that's why we are still on the hunt regarding that. And that's what I tell my brokers, because I do call them.
And so you're active now, or you're passive, or both?
Well, we're actually both. We're looking for our first general partner deal. And we have very specific criteria because we have been passive investors for quite some time. And we did grow our wealth from our seed money. We had some seed money because we had some single family investments also that had gone full cycle. We sold those off. That was part of our exit strategy. We did stagger sale because, of course, we don't want the tax impact too. So we didn't want that in one tax year. We transferred most of that over to multifamily. And we also had some additional seed money because Dan had a significant inheritance from his dad, who was our first private lender for two properties in our single family portfolio. And we grew that wealth. We grew that wealth to a period where, a number where it was like $4 million. So that's where we are, just as passive investment. investors, and we timed the market really well. And I want to emphasize that our entrance into the market in that 2015, 2016 time period was a great time. And even with some of our bridge loan debt that we had with general partners, could do very well because debt was so low. And we can talk about that a little later as you want to, because the environment's a little different, and we should talk about some different strategies and some different challenges, and still the tax benefit that comes with having a real estate asset. Certainly, I love multifamily.
And so maybe I missed this part, but at what point in your journey were you a construction brat?
Okay, in the very beginning, and I did share that with John, that my dad had his own construction subcontracting business. And so I kind of grew up with people in the trades. That was not really unusual for me in as a girl. My dad was a backhoe operator. So I learned a lot about tools and trades and working with tradesmen uh, during that time. And I utilized that knowledge and that understanding and building those types of relationships first when I was self-managing a single family portfolio.
Did you find that your experience as a construction brat helped you both in residential and commercial, one more than the other, or both?
It really has helped me in both because I will tell you, I really do establish an immediate rapport with a lot of people. A lot of
Mhm.
people who are in the trades, even some real estate investors, whether they're in the single family residential space or the multifamily space, because there's a lot of people who own construction companies and they have their construction companies alongside their investment company. In fact, I am in a mastermind with a woman who spouse has a construction company and they are building a multifamily investment company alongside of that. So we were able to really talk shop very quickly because of my background, my real estate journey, and the childhood that I had in a construction operator's home.
Mhm.
So
A
that
lot of people, go ahead.
no, go ahead, Keisha.
Okay. I was going to say a lot of people usually get their start in real estate just like you did with single family homes.
Mhm.
And what would you tell those people for why they should or shouldn't get into multifamily? We'll say as a passive investor first.
Well, I will say that I do love the scalability of multifamily a great deal. And when we were able to time that with the depreciation for the tax advantage, it was really, it was like a game changer because what I was seeing in my single family portfolio, you had to have that carryover loss, and that had to accumulate. And you really didn't get to take the full advantage of that until you sold the properties. So at exit. But with multifamily and with the depreciation schedule, you get to see a lot on the front end. And that is a huge tax advantage for your portfolio as an investor. So, and I have the I've gone through three CPAs, so I have the best CPA who understands real estate the best now of anybody, and I've had that CPA firm since 2019.
Besides that depreciation, I'd be interested to know what additional tax strategies either your CPA or maybe you yourself have employed in your investment journey.
Well, I will say we really do take a look at properties that are being sold. So what's going to be the gain? And because my spouse does still have an aerospace W-2 job, and I am technically the real estate professional, we can maximize our tax strategy, and we can really minimize any tax impact. So that's kind of been our strategy as partners and as spouses. So that's kind of how we operate with that, which we're using that to our advantage. We really are.
Yeah, I was gonna say the rep status is definitely the dream for any couple.
Oh, I know. I will tell you, got a general partner I work with, and he's single, he's an engineer, and he talks about, oh, I need a real estate professional, to offset my engineering,
Right.
salary. And it's like, I'm sorry, you haven't found this ideal person yet, but there's hope. There's always hope.
And in addition to scalability and the tax benefits, how would you compare the returns between investing passively into multifamily versus single family home investing?
Well, I would say that it- it's so much greater in multifamily. Even during the last 2 years that have been more challenging, we've had a few more challenges post-COVID than we had pre-COVID in multifamily. But still, you have substantial gains. And even coming in as an investor, if you are coming in as a sophisticated investor and only at like maybe a $50,000 entry or a $60,000 entry, it is still not the same expense coming in to single family, especially in Dallas Fort Worth. Now, the way that we really maximized our portfolio and gained additional homes in 2008, because that was like credit crunch time. That was tough. Was the private lender strategy. And we went to Alan Cowgill's boot camp to learn how to work with private lenders. And that's how we brought people on, because several banks, including Chase Bank, my bank, many, many years, was not loaning any money on real estate investments. So you had to pivot. So that was certainly a pivot point for us to be able to continue to grow and not just shut down S&D Properties, our first company. And we've added other companies since then that have all been in multifamily, because Dan's had rollovers. So we've experienced rollovers. We've experienced inherited IRA, all of those kinds of situations. And so that's why we also love utilizing LLCs for our asset protection as well.
We have a lot of investors that are either like high earners, high net worth. They're also trying to shield their investments from taxes, as we said earlier. You mentioned IRAs, and do you employ investing from like the self-directed IRAs or any other type of vehicles like that when Dan rolled over his either retirement accounts from one to the next?
He's already done that,
Yeah.
because he's had two different aerospace companies that he's worked for. Bell Helicopter, Boeing, and then he was called back to Bell Helicopter because he has also had expertise on an SAP team. So very highly prized skill. He'd already been part of a SAP team, and so he could just do it again in an aerospace industry. So he experienced the rollover of that from one aerospace company to another. Well, actually, from one aerospace company into a self-directed IRA that was an LLC. So it was nested. And then an inherited IRA into an LLC, also a nested situation or structure. very specifically. And then we have our LLCs that are, well, they're real estate LLCs. So they are not tied to any IRA, any self-directed custodian.
Got it.
Do you invest in anything outside of multifamily? Like, do you do any private lending yourself? Any, I don't know, short-term rentals, or is it just multifamily at the moment?
Well, I do have a small triple net, so I will say that. And it was because I had a sponsor, a general partner I was working with on some passive investments, and he opened up a fund. And so we ended up, taking advantage of that. And because we entered into that fund in the year of 2017, it came out really well because the debt was low. So it's still a low debt environment when we made our entrance into that too. So uh, our fund is performing at a better, higher distributions than the other funds, but it was only because of the debt. It was only because of the debt and some of just a combination of what was being acquired in that particular fund. So the
Uh,
debt has just been really put some challenges out there in the real estate environment in any asset acquisition really has.
I was going to ask about that. In this environment with the debt, granted, the interest rates might be lowered, but not by much.
Yeah.
How has that changed your buy box at all? Or you're still focused on multifamily. Are you investing still in Texas, or are you investing or looking outside of Texas and other aspects of the buy box? Has that changed your perceptive?
Well, our buy box is still the same units. So we're in 100 to 150.
Hmm.
And certainly part of the reason is the capital raise. And, the debt. I mean, the debt is such a huge factor in that.
Mm.
Not only what you can raise as general partners, but also where is your loan gonna land as far as the interest. So still, we're still very conservative in our underwriting. And we are still maintaining or committed to Dallas Fort Worth because uh, of our investor base. Our investors can follow us in that market. It is not a tertiary market. Some people are bold and brave, and we're more conservative in our underwriting. So we're not headed to tertiary markets, even though there are some advantages to the tertiary markets, certainly as far as multifamily. But with nervous investors in the wings, as it is, we feel more confident in Dallas Fort Worth and staying in primary markets versus tertiary.
How would you recommend investors determine what their personal buy box is when it comes to multifamily, for example?
Well, I will say, first of all, where is their home market? Because we are in Dallas Fort Worth. As I explained to John, we are technically 40 miles north of Dallas. So we're sandwiched right in between Dallas and Fort Worth. Both Dan and I are third generation native Texans. Our families have been in Texas a long time. Other individuals may have a different home base and a different comfort in different markets because they know those markets. They've been in those markets. They have resource people in those markets, not only data, but people who have a good feel for where the market has been and where it's going. And also looking at economic drivers. I'm always a big person wanting to look at economic drivers anywhere I invest. I have said no to many passive investment opportunities because I didn't really believe the economic drivers were going to be strong. And in many of those situations, I have been correct, especially with with all those interest rate hikes and the debt becoming what it was. So properties that were kind of solid or, pretty good, became more troubled because of debt. In fact,
And
I will say that I even had a conversation, actually a little DM over LinkedIn with a broker, just verifying what my buy box was, which is what I already told you all. And I really would like my year built to be, latter 70s, at least 70s, 80s, because any of the properties that are older, you're going to have more reserve funds. You're going to have to raise more CapEx budget outside of the loan, because you're going to have those funds in reserve. I firmly believe that you will, because you're going to have boilers and chillers and the plumbing. I mean, that's like another flashback for me from my childhood, because one of my uncles was a plumber. So I had like these blue collar entrepreneurs who were a part of my childhood. So yeah, so you always have to consider what type of plumbing are you really dealing with, and have you had some sewer issues?
well,
And,
we have a question
drainage
that
issues
came.
too. I'm sorry, Keisha. What did
Uh,
you?
no, you're good. You're good, Sharon. One of the questions that came in from Brat is, what economic drivers should you consider when you're investing?
Well, I think that you're really going to have to consider both micro and macro. So on the micro level, you're really going to have to understand where your rents are going. And an example of that is a property that we did pass on because our conservative underwriting would not bear out what one of the investors was paying for that property, and it was in Denton, Texas. But the rents were softer. The rents were softening, and I had the, I guess, good fortune of talking to an experienced property manager who was telling me that the rents in Denton, Texas had been softening since October of this year. So, and then you can, if you're on LinkedIn, I love really uh, following Jay Parsons. He's a chief economist. He's always got great graph data out there regarding what's going on in multifamily, and he's slicing and dicing data all the time. And then I will also be at an event in September, and Neil Baugh will be there. So data scientists. I mean, that's really kind of the macro. He's like the father of all kind of macroeconomic data to see what's going on. But also, I mean, I've even gone on state sites, or city sites, just to kind of see what's going on in those particular markets. And I've done that, and that's some of the data that I've had gotten really quickly, and told general partner teams, no, even as a passive investor, just getting to the data quick and making some quick decisions based on economic data and drivers. So I hope that answers the question to his satisfaction.
And thank you for that. I was wondering, what other KPIs, key performance indicators, do you look at when you try to make a quick decision on whether you want to dive deeper and do, the underwriting for a particular deal? So you talked about interest rates on debts. You talked about softening, maybe rental comps, or maybe the softening economic drivers.
Right.
Are there any like shorthand KPIs that you use and just look at a deal and say, I'm not interested because of CapEx or because of X, Y, and Z?
Yeah, I trying to think about that for just a minute, John. I really do have sort of an idea too regarding CapEx and what the detail is, because even if I'm on a webinar, and this can be helpful for some passive investors, even if I'm on a webinar, I will ask for some underwriting data. I mean, I want to email it to me. Email me your model. I mean, send it as a PDF for crying out loud. But I want to see it and see what the breakdown of that is. So, and then just when you're investing, are you going to want a property that's going to be a heavy value add? And every investor has to make that decision personally. Do you want something that's a little lighter, or do you want, and by lighter, I mean greater than 9,000 a door? If you're talking multifamily, are you going to want something that's really distressed? They're really totally re-tenanting. And I have known teams that have come in and done that. And but they're not going to have agency loan. They had banking relationships, and they came in and worked with bankers to get that done. And they did that in Lubbock, Texas. It was a trio that I knew, and I respected what they did, but they were strong rehabbers, and they knew they could rehab.
Thank you for that.
And I guess like you mentioned debt and the cost of capital a lot. How are you adjusting your strategy for this new environment that we're in?
Well, of course, I am, keeping my ear to the ground regarding what interest rates are doing. So I may be a little more on the pessimistic side than others. If we eke out one interest rate cut, uh, I think that'll be as good as it gets. But that's kind of the camp. That's kind of the camp that I'm in. And I'm also prepared, moving forward as a general partner, to have a strong race. I'm going to have to come in as separately as a general partner to probably bring in 2 million or more. That's what I see. And then we're going to be containing our offers to $15 million price properties. Just, because of the capital raise and the debt. And I will tell you, as a passive investor, I've invested in a property that great little pocket. I've invested in that pocket with a single family rental that did very well when we had our portfolio of single family rentals. But a whole lot of they expanded the general partner team. They just kept adding the partners. And so I'm looking for that in the future, even with any passive investments that I have, that you can't have 15 general partners on a team and then have a steering committee of people. I've seen some real miscommunication. I've seen the general partner team that is struggling to work together, because they had different visions really of what needed to occur on the property as far as the operating side of the house, as well as the capital expense budget side of the house. So the operating budget and the capital expense budget, they were having some conflict over that. And even though general partners believe that does not really affect passive investors, the LP, if you've been investing in multifamily assets for a while, when there's some conflict going on in the general partner team. You can just read between the lines. You really can. I mean, I certainly can. And I certainly call general partners. Say, what's going on? But that's something to really be cautious of. I mean, really.
That brings up a good point where, investors listening at home, how do maybe it's their first syndication, they're in the same shoes that you were, I guess almost 10 years ago now.
Yeah.
They're trying to transition. Almost how many?
I said, yeah, almost 10.
almost 10, yeah. And they're trying to transition from single family to these syndications. What would you recommend they look for in the person, in the team that they're investing in? In addition to the deal, John and I'm sure you think also that the people are more important than the deal itself. How do you recommend people pick the right person to invest with?
Well, I will say that they're real estate bios, and they're questions that I am asking now, even people who investors that I've known many years, uh, that I didn't ask back in 2015. I didn't know to ask these questions, but also the environment has changed a great deal. So now I've asked in a very experienced general partner team that I have known for at least 5 years if they had capital calls and if they paused any distributions. I would never have asked that back in 2015, gentlemen. I would not have. I would. First of all, it wasn't as frequent. It was rarer,
Right.
but I would ask those, but also asking how many of their portfolio, how many properties in their portfolio have gone full cycle. That will tell you if you've got a younger general partner team, or you have an experienced general partner team, or you have a younger team members who have decided to be very savvy and connect themselves with some experienced general partners in that team. So
Would you
those are
have
some
a,
of the things I would ask.
I was going to say, would you have a question that came in? How do you start with very little capital to start investing in a multifamily journey? In other words, any advice on how and where to start?
Well, first of all, I would assess what funds you have available. So you're going to have to do that either way. You're really going to have to. If you've got 50K to start, then you figure out where you're going to start. And I would say if you've got 50K, then take a good look at some sponsors, and are there some individuals who do have conservative underwriting? And I say that because your risk factor will be less because of the conservative underwriting of the general partners. Plus, have they gone full cycle? You know, how long have they been investing? I would just ask some really specific questions regarding some of that, because that's going to lower your risk factor. There are some situations that I'm willing to review, and there's my risk has just increased some. I mean, it's not exponential. It's not like I'm the equivalent of a wildcatter in my multifamily portfolio, but there's some people that I'm willing to take some risk with that I would not have in the beginning, because I've grown our portfolio of wealth. So I've got more money to work with. So you have to take a look at that in the beginning.
Yeah, and I
Yeah.
would just add that most investments do start with 50K. You might find a few that start with lower, but most large multifamilies will ask for 50K as the minimum. So, but as Sharon said, do your due diligence on the operator. That's probably the more important thing to do. Of course, understand your buy box too, like where you would want to invest and what type of asset class.
Mhm. Yeah, because
And just for
I would say at this point in time, mine kind of go on a dual track because I have been investing a while. And I told a very experienced team that, I wasn't going to invest in a particular property. They did take the time to call me. They didn't just have a webinar. They didn't just send emails. They like the emails where, oh, you may have had this in your spam. No, I didn't have it in my spam. I've already been on the webinar. I already took a look to see what that was offering. But in my buy box, even for any passive investment in the future, it's not going to really be outside of my buy box. I mean, that's kind of where it is right now. And because of the debt, I'm probably not going to even invest in larger assets in multifamily, even as a passive investor. And I do have one that's a 418 unit. That's like the largest I've had. But I'm looking at the smaller ones because it's taking less debt, less CapEx budget. You're able to operate it more efficiently. That's kind of my passive investment box has also become my general partner buy box.
And also we do have the due diligence checklist on our website as well. For those listening, if you go to clivecap.com, we'll include it in the description for when we upload it. I can throw it in the chat here too. But we have a checklist about 100 questions, maybe, John.
Right. That's right.
And that goes through a lot of the questions that Sharon here covered, like how many deals have you gone full cycle? Have you ever done a capital call? What was your worst deal? What's your experience, etc. So that you can be more confident that you're putting your money with the right group.
Keisha, that is actually an excellent tool that you are offering to your viewers today.
Appreciate it, Sharon. Thank you.
Sure.
And we did have another question come in here,
Yep.
and it's what are the real estate growth areas / corridors for the next 5 to 10 years? Mainly markets. They mentioned that Texas and Phoenix seem to be overinvested and prices are coming down. What parts of the country, Sharon, do you see, really booming and like the next Texas, the next Florida, etc.?
Right. Well, since I do invest passively and I'm looking for general partner opportunities as well, I will say that in the Denver MSA, I've had investments that have done very well. Had one that was in Aurora, Colorado. It went 3 times on the return, and it was 100 unit, so it wasn't big. It was in my buy box too. Even it was, as a general partner, so that went very well. So I've got one in Brighton that it's not performing quite as well as the Aurora, but it's still got strong occupancy. And they were able to get an SBA loan on 2 properties that were in a block of each other. So that was a really desirable situation. You don't get that every day. So, and I got it with a investor that I was actually a key principal on their note on the Aurora property. So, but Columbus, Ohio too. I've got one in Columbus, Ohio, I think with the exit in probably 2005, possibly. It's going to perform very well. And I've already had one in Hilliard, which is also in the Columbus MSA. It's just a really up and coming sort of area in around Columbus, Ohio, and it had a 3 times return too. So, and I know that there are other pockets outside of that you have investors that are investing in. It's just I don't have the reach or the resources, the kind of the boots on the ground people in some of those other areas. But I do know that there's some investors that are concerned about water issues. Phoenix, are they going to run out of water? We don't know. And just the population growth. And Phoenix is a really hot market. I do know investors in Phoenix, and it's a really hot market, but it's not driving me to be tertiary yet. I still like Texas Triangle, probably because I'm a Texan, and I've even been at events where they talk about where commerce travels. Even across the border from Mexico, there's a lot of commerce that is conducted, between Texas and Mexico. And you've got San Antonio, you've got Austin, even though Austin is pretty a pretty overheated market in some areas. And then, of course, Houston. And John and I talked about Houston before the program. And, Dallas Fort Worth. So a lot of commerce is conducted. Like I think 82% of the commerce for the state of Texas is conducted within that quadrant, what they call the Texas Triangle.
If you're looking
These
at,
markets,
go ahead, Keshav.
I was going to say, do the markets that you mentioned, do they apply to single family homes as well?
I think that I think there's probably opportunity there. I will say, as far as single family, you might need to think how close you are to the coast. And I have to do that even with my multifamily portfolio, because even my Houston property, which I do have one in Houston, it's on the northeast side. So even Hurricane Beryl coming through, there was minimum impact to that apartment, and it was like 100 unit. I mean, it was still buy box, even though I was a passive investor for that particular property. And of course, you do have to take a look at property tax and insurance in Texas if you are looking at that, because that is well, it's significant. It's a significant expense and a significant within your for your buy box and in your modeling.
I was going to ask about, so we talked about market cycles a little bit. How do you know when a market is in the down cycle? Is it supply demand, inflow outflow of transit, people moving in and out of states, and businesses in and out of state? What are some indicators for you that you've used?
Well, I do take a look at movement in and out, but I will tell you, I've been at events where there's some individuals who've shared some things with us. Some of those are like one of the owners of Madera Properties out of Lubbock, Texas. They even and Neil Bawa would love these people because it's like a neighborhood to neighborhood strategy. And I know that Neil Bawa with Bawa University very strong on this. And I'm looking forward to that September event where I do hear Neil Bawa again. I've heard him once already this year, but you can never hear him enough. You can never hear that wisdom enough as far as his modeling strategy. But it can even be on a neighborhood basis, because one of the things that we learned well, no, it wasn't in July, it was actually in May, in Dallas, Texas. There are neighborhoods that are on the rise, and then there's some that are on the decline. At one point in time, Uptown was a neighborhood within Dallas, Texas, that was on the rise. Well, now, post-COVID, it's a little more on the decline. And Knox Henderson is an area that is on the rise. So it can even get more at a micro level like that, as far as your assessment and reviewing the markets. You can't paint too broad a brush, or you lose some of the nuances and some of the details that are so critical to investing strategies.
Along your journey from, where you started, from construction brat to
Construction
single
Brat.
family home to multifamily millionaire now, what were some of the biggest mistakes or challenges that you had to surpass?
Okay. Well, knowing when to pivot, I think that was really critical, because in the beginning we were starting out our single family portfolio. It was small. That's why I was self-managing, because I really needed to keep those expenses down. Well, then we have the 2008 time period with the credit crunch. Well, I had Alan Cowgill on my radar for some time. I'm like, okay, am I going to have to keep this man in my back pocket because I need to have the skill set of working with private lenders? Well, I did. I had to go into a boot camp in San Antonio, Texas, to learn how to do that. And I had people that came on board with me because we already had some single family homes. They already had some confidence in us, and they came forward and they invested with us on multiple projects. We just couldn't get enough houses for them. That was the situation because we were growing our private lenders, but we couldn't scale our single family portfolio fast enough to keep them on projects. And that's when we turned to multifamily. And we found Brat Sumrock in 2015. Now, I will tell you, in 2023, I sought out another resource. And I joined my second mastermind. I'm into one with Brat Sumrock, and that is the Millionaire Multifamily Mastermind. And now I'm in Raise Master too. So I'm getting some resources regarding the capital raise because you just have to have that strong and in the zone and have the investors that are going to come with you on your journey. And they're going to be confident in you, and you're going to show them that you are a person to invest with. You are trustworthy, and you both understand that too. You have to be trustworthy and authentic and full of integrity. And that's been my latest pivot. And I'm learning so much, and it's like drinking from a fire hose all over again. And I've had those situations in my life where I've just had to learn at a rapid pace and understand how to bring on resources. And now I have a marketing team, and utilizing multiple social media platforms as well, and just understanding when you have to do that and anticipate your need. Really anticipate. Try to get those resources on board before you need them, because then you can't be in an expansion mode. You can't expand because you need the exponential tools and resources and people to get you there.
Okay. Well, we have a few minutes left here. So with that, we're going to wrap up with the questions. Some of the questions that we like to ask every one of our guests. Starting off with, for those who are just getting started in multifamily investing, what are some of the biggest fallacies or falsehoods that they should be aware of?
That it's easy. That even if you're a passive investor, you don't have to pay attention. That you don't really need to read those monthly reports. You really do. You need to call your general partners. You need to talk to them about questions. It's a bi-directional relationship. It's not one way where you send the money and it's on autopilot. It's not. It's something you have to pay attention to. And then you also have to determine your own risk factor, but also what is your threshold? What are the funds you have to invest with? And how do you want those to grow? And also, I will say, be proud of the journey you're on, because a lot of relatives, a lot of friends, they're going to treat you like you're weird. They really are. And I've experienced that, and I'm willing to just say it because I've had that experience. And they don't think I'm so weird now, but I was on a journey, and I saw what that journey was. It was like a vision quest of investing. And I saw that journey could really lead to a really prosperous place. And I have some great experiences. I have a 28-year-old daughter. I can hop on a plane and go visit her. We can have adult conversations. We have real estate conversations too, because she kind of grew up in all of this. And we are adding on our latest LLC, and she will be a partner in that. She has some funds to invest. She's a consultant in Washington, D.C. It's a pricey place to live. However, I can do these kinds of things, and I can be generous with my family. I am the favorite aunt and great aunt. I can afford to be generous to these people. They don't have to give me anything. I can just give them fun stuff because that's what I want to do. And I don't have to be worried about it. I don't have to be worried about my incoming bills. I don't have to be sad about what's being emailed to me or what's in my mailbox or whatever expenses that I have, because I can handle that. I can handle what is going on, and I have confidence in that. And I also, being in my masterminds, I can get to go to some cool places and have access to people who are really smarter than me. And what a blessing that is. It's just a blessing, and I don't have to be the smartest kid in the room. I really don't. And often I don't see myself as the smartest person in the room. I ask a lot of questions and I pay attention to what people are doing and I listen very, very closely. And that's another thing I would tell incoming investors. Listen very closely and make sure anyone's actions align with their words. Because if there's not alignment, you may not want to be investing there.
And lastly, how do you give back to your community?
Okay, how I give back to my community is through my church. We have some local ministries, which include a food bank. So it is a food bank for homeless and individuals who just are really struggling to make their budget work for them, so they can go and have a hot meal. They can have some shelter, and that is Our Daily Bread in Denton, Texas. And I also give to Interfaith Ministries, and they help individuals because I have been a landlord. There are individuals who are really struggling with the high electricity bills during the summer here in Texas, and they are one of those not-for-profits that really help with that gap. But one of the newest charities that's on our radar screen is Share the Love, and they give wheelchairs, just standard wheelchairs to people in America, but also in Central and South America. And these are individuals, and it's so heartening to see. And I was in Punta de Mita when they had a distribution with our mastermind group. And some people have never had a wheelchair. They have needed a wheelchair since they were born. And members of their community have been carrying them. Family members have been carrying them. And they're so delighted to see and receive a standard basic wheelchair. They're so, so grateful. And it's something that is just so standard that I think everybody should have access to that. So there's less burden upon the community because they love their members so much. They love their community members so much. They love their family members so much. They are willing to do this, but uplift the whole community so they don't have that. So the individual has some freedom of movement. And it's just, I don't know, I think it's just a dignity everyone should be able to have.
Well, thank you so much, Sharon, for coming to present on Construction Brat to Multifamily Millionaire.
Well, I'm really glad that you all know more of my journey now, especially on the Construction Brat humble beginnings.
Yeah, it was fun to learn about. So, for those of you listening at home, feel free to reach out to Sharon at her email, Riddle, Riddle, DSN at Verizon.net, or her website, X, maybe this is mistyped, Excalibur, Texas. Is that right?
I'll go ahead and spell it for everybody. It's
Yeah.
www.excalibre Texas.com.
Yeah, that's what I figured. We'll include this contact information in the description for the podcast episode, though, as well. So thank you again, Sharon. We definitely learned a lot about your journey and how anyone can get started from, no real estate investing to getting into multifamily.
Well, I'm happy to be here with you today and to be on the show. And Keisha, you and John are very diligent and very serious about the work you do, and I admire that.
Thank you so much,
Thank you.
Sharon.
Thank you very
We
much.
appreciate it.
You're welcome.
And for those of you listening at home, don't forget to like and subscribe to our podcast on whatever platform you're listening to make sure that we can continue bringing you the best educational content. Thanks, everyone. And until next time, keep investing for generational wealth.